Well, let me just start off by asking the most broad question, which is, it's been almost 5 years now since the bankruptcy of Lehman Brothers and the onset of the 2008 global financial crisis. What do you see as the biggest changes pre- and post-crisis in terms of the financial markets, investors, and also the behavior of the financial institutions?
Well, this has been a landmark change, and I think historians will look back at that period and say that was a very big change in our economy. So from the period, certainly from the early 1980s until around 2007 or 2008, we lived in a world of generally declining interest rates. Interest rates peaked in the early 1980s in the United States. And have basically fallen ever since. So let's say most investors who are under 50 years old or so have that as an experience and as a background. That was a world that was, because of those declining rates, leveraging up, particularly in the developed markets. Individuals levered up in housing, consumer, everything else, and governments to some degree levered up. So when we found ourselves in a situation with too much leverage and much of that borrowing on something that couldn't be substantiated, we had a crack in the system. And one of the reasons we've had such a slow recovery is because this isn't like other financial crises, which are really overproduction crises. This is a financial crisis, and a financial crisis tends to take twice as long to recover. And the big differences from a macroeconomic point of view are that governments using the traditional Keynesian fiscal stimulus are not able to do that because they had already borrowed so much. To some degree, we've seen a removal of the balance sheet of individuals who are deleveraging to the balance sheets of governments who have increased their leverage. And then, of course, the other big experiment has been the massive increase in monetary policy, which is truly a non-traditional way of expansion that remains to be seen how successful that will be.
Well, the impact of this crisis has actually lasted longer than perhaps expected a couple of years back. And you just mentioned the characteristic being a financial crisis tends to prolong the recovery period. But how do you see the markets going forward in the next few years? And also, how do you see the global economy recovering in the next few years?
I think we'll have, hopefully, a slow recovery. But I think that anyone who looks back and uses models over the last 20 or 30 years is probably making a mistake. So I constantly hear this is like 1993 or this is like whatever other period, and it's not. It's a new period. So at some point, this long-term fall in interest rates will stop, and we'll see a rise in interest rates. So while that's been the best place to invest in some ways over the last 30 years, but certainly over the last 10 years or so, I would caution investors about their fixed income investments and what can happen with them. The equity market has certainly had a recovery, and it's at new highs depending on the market. A lot of that is not because of underlying fundamentals of the companies, but rather because of this massive economic monetary stimulus. So in my opinion, part of that is a type of inflation, if you will. The monetary authorities are trying to increase the value of our assets so that we feel more confident and more wealthy, so that we'll go out and spend more. There's an old saying that you don't fight the Fed. So the monetary authorities of the world are in some ways standing on a box and yelling at us, telling us to go out and make levered investments. We're hesitant to do that because we were burned so terribly last time. But it's likely, we hope, that that policy will work.
Just to expand a little more on that, so a lot of this, the recent rise, the recovery in the stock market, for example, you mentioned, is more based on the monetary policy. Is there any worry about it causing an asset, kind of artificial asset inflation problem, if it's prolonged?
Well, yes. The short answer is yes, you have to worry about that because whenever there's a growth based on monetary policy, that has traditionally been a possible bubble. But the bubble is unlikely to pop as long as monetary policy keeps expanding. So to some extent, the greatest surprise over the last month or so is Japan's jump into expanding the money supply, an enormous expand in the money supply. And whether that will work or not, we don't know. But the likely repercussion of that for investors is an increase in money supply that's going to go into the markets around the world. So surprisingly to some, bond market yields fell and stock prices rose because Japanese investors are likely to take an enormous amount of money and invest that around the world.
Maybe just to expand a little more on the recent policy, the monetary policy of Japan. Now, it has also impacted the exchange rate considerably. From the Korean perspective, this is a little bit worrying in terms of the impact it'll have on the competitiveness. What is your view on this? The impact not only on Japan but also on its neighboring countries, in particular Korea.
Yeah, it's very interesting. I just came back from Japan last week. The Japanese economists, strategists, analysts, as well as our local team are pretty enthusiastic about this. I suppose I'm a little more tempered in my view. I'm concerned about the effect on other economies, but the Japanese are not. We're really living in a world where the developed markets are in such difficult times that they are just trying to stimulate their own economies and are not so worried about how that affects other economies. Now, the Japanese would say they do not have a currency policy. It's a monetary policy, and the currency effect is a spillover on that. But it's certainly going to affect Korea negatively, at least in the sense of exchange rate. I think it could affect Korea positively in the sense of greater demand for Japanese, for products globally, but including Korea. And I think it also, I think Korea is actually had a big window of time to become very competitive and is not so dependent on the exchange rate. So I think in that sense Korea is less likely to be hurt. A country you don't hear a lot about but could possibly be hurt would be Germany. Germany has had a great benefit from the high exchange rate in Japan. The exchange rate in Japan was painful. It's probably the only place in the world where I traveled where I almost felt physical pain going from the airport to the office because it's so expensive. Right. So Japan was the great shock absorber in terms of the currencies of the other developed countries. America, Europe, even to some extent emerging markets will let their currencies kind of float in a sense, not on a direct basis, but on an indirect basis with Japan. So in that sense, I think it makes sense. The question is, how far will the Japanese currency go?
Shifting gears a little bit, I know you've had extensive expertise and also experience with emerging markets, both as a professional and also having lived in many of the emerging market centers, major centers. What do you see as the kind of the shifting dynamics of the emerging markets from a global investor perspective?
Good question. First of all, I have a problem with the concept of emerging markets or the idea that emerging markets are a separate asset category. I think at maybe one point they were considered these very small, very risky economies. At this point, those indexes are to some degree political, and I think probably you know that better in Korea than almost anywhere, because now in some emerging markets indexes Korea is included, and in others it isn't. Right. So I think it's better to look at investing from a global perspective, including all investable markets, and not separate yourself into those that are developed and undeveloped, because that line is not clear. That said, those markets that were considered emerging have changed dramatically. I first went to China in 1982, lived there for a while. I've also lived in Brazil, as you mentioned, and other emerging markets. And I was just in China 2 weeks ago for 10 days, so I've had some very recent experience there. And China has had, of course, a fantastic growth rate, but it can't continue at that growth rate. And you see it now everywhere in the ghost towns where, which even in Beijing, there are a lot of developments where you see beautiful buildings but not very many people. You see it in the terrible pollution that they have. So China's going to slow down, and China has really been the engine of most emerging markets. So even an economy like Brazil, although it does have a lot of domestic consumption, it's still pretty dependent for its marginal growth on the growth of materials from China. So we're going to see some slowdown in the growth of emerging markets. I think they'll still outgrow the developed markets, but not the growth we've seen in the past. And a shift from probably less export-driven to consumer-driven. I think that you probably hear that from a lot of people you interview, so you have to be careful on the price of the consumer stocks, but at least from an economic point of view, that's the likely trend that we see it. Anyone who visits China can see it's clearly moved towards consumption. From the old days when I was there, when your choice of clothing was a green or a blue mouse suit. So it's changed and will change in that sense. But I would look for a slower, but perhaps more stable growth from China, and the spill-off from that will be more stable growth in other emerging markets.
You also just mentioned Korea, the case that it's kind of an ambiguous situation. It's one of the top 15 global economies, and it's also a member of the OECD. But in terms of its financial markets, it's regarded somewhere between a developing and a developed market. From a global investor perspective, in their portfolio, what is the position of Korea in its financial markets, and what are the benefits and weaknesses that it possesses?
There's a famous American comedian called Roger Dangerfield. And in fact, he just passed away in the last couple of weeks. And he always used to say, no matter what I do, I get no respect. That was his famous line. And Korea is kind of like that. Korea is the most successful market in the world. Over the last 60 years, there is no country that has been as successful as Korea. As probably all Koreans know, China, India, and Korea were about the same GDP in the early 1950s, and obviously Korea's pulled way ahead. Koreans know that, but the world doesn't know that. I don't think that Korea gets the respect and honor that it deserves, or knowledge from the rest of the world. And in many ways, Korea is kind of a pathway for how other emerging markets can develop. So if I were a China or a India or a Brazil, I would send a lot of my government officials to Korea to learn what Korea did. That said, Korea is certainly in a transition phase. In my opinion, it's not an emerging market. It's now a developed market. I believe it's the 15th largest economy in the world. I travel a lot in Europe. I can tell you the dynamics for whatever problems Korea has, including demographics and regulatory issues. It's worse in many ways in Europe. So I see Korea as pretty positive. I think there's a lot of opportunities with Korean companies, but I also think there's long-term opportunity with Korean bonds and currency as well. I think over a long period of time, Korea's currency is likely to appreciate and its companies to grow. So on a global basis, we're pretty much fully weight in Korea. It's funny for me, I'm from California, so that's the heart of Apple. Just Cupertino's just a little ways away, and to see Samsung here, which we're big investors in, it's great to see that success.
As you mentioned, Korea gets perhaps a little less respect than it deserves, and for example, the Korean companies' price-to-earnings ratio may be lower than what they should be. What do you see as perhaps an explanation for this fact? Some have pointed to, for example, the issues with governance of companies, and there have also been other explanations. What is your view? Do you view that Korean companies are undervalued, and if so, or if they're not undervalued, what do you see as perhaps the problem?
Well, corporate governance is an issue. The complication of the major companies for analysts to understand Korean companies is an issue. In the short term, I think there's been a lot of concern about Japan's effect on Korea. But that said, foreigners are a significant part of the Korean market. I don't know exactly, but it's a higher percentage than a lot of other markets. I think one of the issues with the Korean companies is yield. Generally, yield stocks globally have outperformed lower yielding stocks. So I think if you probably separated that out, you'd find that the Korean companies that don't have yield are not so undervalued. And I'm not sure PE ratios alone are a very good value measure. You really have to look at growth of the company. And increasingly, a lot of analysts look at a discounted cash flow model, or what is the likely return to the investor over a period of time. So I think that probably explains the Korean market. We see the Korean market as kind of fairly valued right now relative to other global equity markets, but probably it makes sense to invest in equities generally compared to fixed income if you look at the likelihood that fixed income interest rates are unlikely to drop more.
Korea is, last year and continuing to this year, there's a lot of discussions about Korea's economy slowing down, that perhaps it is now entering a prolonged phase of low growth and also low interest rates. Some have also raised concerns, perhaps we are going through the path of Japan 20 years ago. But if it is likely that Korea's growth and also interest rates will be flat for an extended period of time, what advice do you have for Korean investors and also Korean financial institutions that are now finding it difficult to find the kind of the risk-return profile within the country itself?
So first of all, Korea is not Japan 25 years ago. Japan had incredibly bloated real estate sector that almost the world has never seen before. Japan had an inflexible financial institutions, so their banks took a very long time to write off bad debt. Japan was in denial about the problems they had for a very long period of time and didn't really respond to them. So I do not see Korea as being in the same situation as Japan. That said, as an investor, our general advice is to diversify outside of your home base. So what would that mean for a Korean investor? I think that a lot of retail investors were hurt pretty badly investing outside of Korea in the last decade. And I think that part of that was because of currency shifts, and part of that was their investments outside of Korea were in kind of the hot markets of the time, and that probably didn't make a lot of sense, or certainly in retrospect it didn't. So my advice would be to invest outside of Korea in a diversified market. We haven't talked about a lot of markets, but frankly, relative to a lot of markets, I think the United States looks quite positive now. And within the United States, if you can invest in something diversified, more income-oriented, that has some good balance between equity as well as fixed income. A lot of the higher yielding instruments in fixed income are doing very well right now. That type of income type of fund, I think, could make a lot of sense and is less risky for Korean investors than some of the things that they did in the past. I wouldn't jump into it, but it is something that makes sense over a period of time.
You are probably well aware the situation in Korea recently, the geopolitical situation, the tensions have heightened quite a bit. But the markets have been quite stable, especially compared to the past when similar situations arose. What do you attribute to this apparent increased resiliency of the Korean market? And also the foreign investor perspective is also more stable than in the past.
So on this one, let me speak a little bit from an American perspective. So I think from an American perspective, and I can't speak for the government, but I think the general perspective is that North Korea is very unlikely to actually do anything this time. And America, to some degree, feels like it's been blackmailed in the past and it's not going to give in on this. And from what I talk to South Koreans, they generally agree with that. That said, this is what you would call a black swan or a high-risk event. So even though the probability of something happening from North Korea is quite low, the consequences are very, very high. So from an investor point of view or from a risk manager point of view, you have to weight high negative consequences very high, even though the probability is very low. So I would say foreign investors are completely ignoring. It's probably more affected by currency rates than anything else. I came here from China. The plane was loaded with Chinese tourists, so the Chinese don't seem to be worried. But I think that's something to have in the back of the head. But certainly foreign investors are not taking that into account.
Well, that's good to know. Perhaps, given the time, one last question.
Sure.
There's been also a lot of concern, it has always been a concern about the financial market and also the currency market volatility spilling over and affecting the real economy. And last year there was a lot of discussions about implementing capital market controls such as the Tobin tax or some other versions of it. What do you see as the impact if such measures were to be implemented from the foreign investor perspective?
So those types of taxes are controversial, and in my opinion they might make sense if they could be done across the board with a lot of different countries. But for one country to unilaterally do that, it's very harmful for that country. So I'd give the example of Brazil, where there was massive flows. And they had a very punitive tax on both equity and fixed income. The tax as high as 6% of all flows. It immediately stopped the flows going into Brazil. Brazil, from an economic basis, hasn't done very well since then. That's not the only reason, but it's one of the reasons. And now Brazil wants foreign investment, so they dropped the tax for equity investors, and they're looking at dropping the tax for fixed income. So I think that you have to consider this tax very carefully, and I think you'd want to give yourself the flexibility, if you want more foreign investment, to take it off. Korea and other emerging markets are in a difficult situation, is what I alluded to before. The developed markets and their monetary expansion, they're not really taking into account the consequences on emerging markets. And it's hard for emerging markets to know how to respond to that. But certainly they need to protect themselves in some way. In fact, this more recent expansion in Japan has not had such, at least in the short term, has not had such a big impact on emerging markets or Korea, where you'd think there would be a bigger impact than the United States quantitative easing in the past. So I think it's a tool that could be considered, but I think you have to be quite careful.
So you would definitely recommend that it needs to be a more multilateral kind of an agreement?
Multilateral would be definitely better.
And then Korea also needs to somehow get more involved in the kind of the changes that are going on in the developed markets in terms of the market regulations.
Yeah, I think Korea needs to have a place at the table with the other developed markets.
Is there any other topics perhaps that was not covered, perhaps you would like to maybe just briefly talk about? Or?
Well, I think it's more a personal issue, but I've been coming to Korea for a long time. I'm responsible for the local investment group here, and it's always a great pleasure to come here to meet Koreans and to talk to Koreans. And a little bit, I should know better, but I'm always pleasantly impressed with Koreans' sophistication. So I think I think the world needs to know more about Korea and understand Korea, and I think particularly in emerging markets, a lot of them could learn from Korean investors. When I'm in Brazil or other places at a forum like this, I often advise them to find somebody from Korea to come speak because of the great experience of Korea. That said, because of the growth in Korea, it's been a great long run in both investment opportunity for most Koreans, because it's been hard to find something else that has the same growth. But it is likely to have slower growth in the future in Korea, and it's a good idea to diversify your investment opportunities. So if you're not somewhat invested in the developed markets in the United States or globally, it's probably a good idea to have some diversification there in the lower risk investments in those markets, and and perhaps initially in some of those some of the higher yielding areas in those markets where you're going to have less volatility likely in the investments.
Well, thank you very much.
Thank you very much. I appreciate it.